The golden rule of investing is simple. Buy low, sell high, but timing the market's manic swings usually leads to panic selling and wealth destruction. In 1958, Philip A. Fisher introduced a radical alternative to that cycle. His book, Common Stocks and Uncommon Profits, became the first investment guide ever to reach the New York Times bestseller list. Decades later, Warren Buffett publicly credited Fisher's book as a foundational blueprint for his own massive investing empire. Throwing out standard Wall Street spreadsheets and applying Fisher's 5 practical takeaways forces you to evaluate companies like an investigative journalist rather than a day trader. Takeaway 1 is the scuttlebutt method. Fisher believed that instead of reading sanitized financial reports, investors should tap the business grapevine. You interrogate a target company's competitors, their suppliers, and their customers. This chart shows the jagged trajectory of the 2000 to 2002 bear market. Fisher's son navigated this collapse using his father's exact method. While analysts hyped stocks like Enron, Kenneth asked their competitors and vendors. Suppliers saw no real order volume, and competitors weren't intimidated. The businesses were completely hollow. Ground-level scuttlebutt cuts through the noise. It provides a reliable shield against buying into corporate fraud, because baseline business realities cannot be faked on the street. Takeaway 2 requires looking past the balance sheet to assess a company's anatomy. Fisher developed 15 points of greatness to evaluate an organization, focusing on qualitative traits like research effectiveness, high profit margins, and unquestionable management integrity. Decades after the book's publication, Forbes editor James Michaels sat down with an 89-year-old Fisher to distill his framework into a single decisive test. Fisher offered one specific question to ask management: what are you doing that your competitors aren't doing yet? That final word demands a continuous forward drive. A company with a compelling answer to that specific question is actively dominating its future market, rather than comfortably coasting on past success. The third takeaway targets the illusion of market timing. Pausing investments because of broad economic forecasts or interest rate fears rarely works, because macro trends are notoriously difficult to predict. This split-screen visualization compares the performance of American Cyanamids divisions in 1954. The crowd heavily undervalued the stock because they focused entirely on the company's stagnant chemical division. Fisher ignored the general market pessimism. He looked at the curve on the right, the company's literally pharmaceutical division, and saw explosive unpriced growth about to overtake the core business. He ignored macro market trends and focused on high-quality internal growth. For Fisher, successful timing meant buying a great company exactly when the crowd misunderstood its true worth. Takeaway 4 is a strict mechanical rule. If you find a great stock, buy it at the market price and never quibble over fractions of a point. To prove this, Fisher shared the story of a highly capable investor who wanted to buy 100 shares of a promising company. The stock was trading at 35.5, but the investor stubbornly placed a limit order at exactly 35 to save $50. The price never fell back to 35. The order didn't fill, and the investor walked away empty-handed. This bar chart visualizes the mathematical penalty of that decision. Over the next 25 years, that stock split repeatedly and skyrocketed to the equivalent of $500 a share, resulting in a staggering $46,500 missed opportunity. Using rigid limit orders to squeeze pennies out of a purchase is pure financial lunacy, when the goal is to capture massive long-term appreciation. Takeaway 5 redefines the exit strategy. Fisher argued there are only 3 valid reasons to sell a stock. You made a fundamental mistake, the company's fundamentals have degraded, or you found a vastly superior opportunity. He applied this rigor to Motorola. While the financial community wavered, Fisher saw exceptional manufacturing and a deeply loyal workforce on the shop floor. Because the underlying business remained strong, he held Motorola for 25 straight years, completely ignoring the inevitable market dips along the way. Staying locked in for decades eliminates compounding brokerage costs and tax hits, allowing the investor to quietly crush the S&P 500 average while others panic sell. To replicate Fisher's success, rely on ground-level scuttlebutt. Hunt for the 15 points with a special focus on the word yet. Time your buys based on reality rather than forecasts. Pay the asking price and almost never sell. Now, put this to the test. Pick a publicly traded company whose products you use daily and apply the scuttlebutt method. Ask their competitors or suppliers how they are doing. What do you uncover? Let us know in the comments below. And while you're there, tell us the title of the next investing book you want us to summarize. If you like this video, please like, share, and subscribe to the channel for more.